So based on all this data, are we on the verge of a recession? Well, in my mind, a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. For me, the definition of a recession feels just disconnected to its actual meaning. It completely lacks the human costs. Businesses collapsing, losing their secure jobs, maybe their homes, and then potentially even their lives. But then I do appreciate that this isn't the likely outcome for most people. The biggest impacts from the next recession will be towards our investments, whether it's our portfolios which are in a tax wrapper or maybe even our retirement savings. Losing money isn't fun and it will never be fun. So in this video, I want to review all the well-known indicators which foreshadow recessions. There will be no fear-mongering in this video, just real data and my thoughts on where we might be heading. You're spoiled for choice when it comes to indicators, but let me call out the obvious first. Not one single indicator is an absolute predictor of a recession, but they may give us a hint on where we might be heading. Think of them as a potential canary in a coal mine. The more canaries we have singing, the more certain we can feel that the next market crash could be just around the corner. To give us a little bit of structure, I'm going to group these indicators into 3 buckets. We're going to have confidence, economic output, and money. Let's start with confidence. You might question why we even care about confidence when it comes to the state of the economy, but you should, as it means a lot. Everything in our economy is interconnected, meaning a person feeling less confident and spending less is another person's reduced income. Ray Dalio puts it best in his great video on how the economy works.
Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle.
So we have 3 confidence measures to look at: the Investors' Fear and Greed Index, consumer confidence levels, and then CEO confidence levels. The first is the Investor Fear Greed Index, which gauges how greedy or fearful investors are feeling at the moment. This takes into consideration lots of factors, including junk bond demand, market volatility, stock price strength and depth, put and call options, as well as safe haven demand. They judge us on a scale of 100 for extreme greed and 0 for extreme fear. As it stands right now, we are extremely fearful, with a score of just 14, which is a modern day low. It's only been lower twice before in our last 20-year period, which was the bottom of the 2008 financial crisis and then at the bottom after the outbreak of COVID, where it was just 12. For a comparison, we have had moments where we've been close to 90 in just the last 12 months, so the sentiment has quickly and drastically changed. The second measure is CEO confidence. After all, even though CEOs make up a very small portion of our society, they are the ones making the big decisions on where they're going to invest next. Are they confident, leading to increased investment and expansion for their businesses? Or are they slightly fearful and wanting to tighten their belts and maybe looking to make redundancies across their workforce? On the same measure from 0 to 100, CEO confidence is currently just below 60 after coming off a modern all-time high of 82 at the back end of 2021. Even though 60 is a respectable score, it's worth noting how quick this has declined over the last few months. You could see the run-up to the 2008 financial crisis had a similar decline, which was prolonged over the 4 prior years. Lastly, and probably most importantly, we have consumer confidence. This is the most optimistic of all the indicators so far. On a scale of 0 to 150, current confidence is 110 after a short fall from 130. Compared to recent history, even with the pandemic, consumer confidence has remained quite high. But, as you can see from this chart around the 2008 crisis, consumer confidence doesn't seem to be the best indicator of economical health, as confidence remained high ahead of the 2008 crisis, meaning this could be more of a trailing indicator rather than a leading one. Next, we have economic output, like the definition of a recession being generally identified by a fall in GDP in 2 successive quarters. So let's look at some of the building blocks of economical output to give us a steer on where we might be heading. The US ISM Manufacturing Index is a measure of if manufacturing is growing or potentially shrinking. For this indicator, anything above 50 is considered growing. As it stands, we are currently at a score of 59, which by historical standards is high, meaning by this measure there is a strong economy with good levels of demand for products. By the same token, we can look at housing starts. So how many new houses are being built? As you can see, the amount of houses we're building is increasing year on year ever since the 2008 bottom, with only a small blip for COVID. Again, another indicator to show that the underlying economy is fairly strong. Lastly, we need to look at unemployment levels. As of today, unemployment levels are not quite beating our pre-pandemic levels, but we're not far off at all. As time goes on, we are still continuing to see this lower, which is a good sign. As it stands, we are just below 4% without any signs of this increasing. But if we did see signs of this starting to increase, then it would be a worrying sign for things to come. Overall, economic output looks like it's in a fairly good place. So let's round this off by looking at what we're all here for: money. There's plenty to look at here, so let's dive into it. I will start with the one that you've most likely seen on social media over the last 2 weeks. One strong indicator of a potential recession is the sharp increase in oil prices. In this case, there is a strong correlation between oil jumping 50% above its trend line and an impending recession. 6 out of the last 7 times this happened, a recession has followed. Scarily, this indicator has flashed up for the first time since 2008. After a very close scare in 2016. Next, we need to look at 2 indicators side by side to get a view of if the economy is in a good shape. This is by looking at the levels of inflation versus wage growth. If inflation is higher, then consumers won't be able to spend as much, as they relatively won't have as much to spend. Right now, inflation is running at 7.9%, which is actually the highest it's been since the late 1970s, meaning the cost of goods is 7.9% higher than it was just the year prior. So if goods and services are 7.9% higher, then wage growth needs to have grown on average by 7.9% just to keep up. Well, when we head over to wage increases, we can see right now that wages are up 9.2% since the same time last year, which means we should be in a good place, as people should have around about 1.3% more to spend on goods than compared to last year. The last money indicator I want to look at is bond yields, with an emphasis on the yield curve. The reason why the yield curve is important is that traditionally, an economy with a positive outlook would offer higher returns for bonds which have a longer maturity, meaning they would reward borrowers more for the longer duration of which they are lending the money for. However, when the outlook for the future isn't good, then this can sometimes flip and cause an inverted yield curve, where borrowers are potentially incentivized more to lend their money for a shorter time frame. This is a famous indicator, as recessions tend to follow an inverted yield curve between 1 to 2 years after. Well, when we look at this chart, you can see highlighted in red where the yield curve inverted. And the last time this happened was at the back end of 2019, indicating a potential recession in 2020 or maybe 2021. As we all know by now, this did not happen and we got a pandemic instead, which I'm fairly sure isn't correlated. Some are showing a strong economical backdrop, with others indicating that we might have some instability coming. Based on all the data, are we on the verge of a recession? Well, in my mind, I can say that I don't think we're on the verge of a recession right this second. However, I think we soon could be. Let me explain. Quite frankly, for me, there are too many solid indicators which demonstrate a strong economy. Confidence for the most part is high, even though it is declining, and economic output is holding strong, if not growing. Yes, the yield curve did invert shortly before 2020, but I would argue that any weakness this might have indicated would have been resolved by the economic measures that were put in place following the pandemic. To top it all off, I think it says a lot about investors as they're incredibly fearful at the moment, yet the markets have only dropped by 8%. For me, this has to indicate that there's a lot of upwards pressure on the market. For me, the indicators which would grow my concern the most would be if the CEO confidence levels kept on falling, and this was coupled with some of the economic output indicators starting to soften slightly. But in saying this, I am slightly concerned on where we might be in the next 18 months. Even though there's evidence that wage growth is outstripping inflation, I think consumers could be in for a massive shock shortly. Wages have grown quickly in America, but this isn't representative of the wider world where wages are still lagging behind inflation. On top of this, I think it's highly likely that the sudden increase in the prices of oil is going to have a swift and brutal increase of inflation, which is already high. Wage increases tend to lag behind inflation due to the way the economy works. Businesses firstly take the inflationary hit as their raw costs increase, but then they quickly pass on these increases to the consumer by increasing prices. Shortly after, they then have to pay their employees more money as the cost of living increases. This, in my mind, leaves a significant gap where the consumer is exposed to a significant increase in the cost of living, all the while they're being paid the same salary. This then can create a negative feedback loop though, as individuals won't have as much disposable income, so they won't be able to spend as much with companies on goods and services. And if companies aren't expecting this, they then may have to make cutback themselves if their sales aren't as high as anticipated. I personally don't think that high inflation has to be a bad thing within a limit. However, I think the speed of which inflation comes through is a big factor. If this comes through too quickly, I could see this quickly putting downwards pressure on the economy, causing a decline in the market, a recession, if you will. Downturns should be expected as an investor. And based on this, I won't be changing my investing strategy for 2022. If you're curious in knowing what my strategy is, then you might want to check out this video on the screen, as I'm fairly transparent about what I'm planning on doing. That's all for this video. See you in the next one.